Hello, everybody. This is Chuck Carnevale, co-founder FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another 2-minute drill, lessons in valuation subscriber request series. This is another video where I'm going to do a high-level look and really try to find some lessons in valuation. A lot of these stocks are stocks I've never looked at or maybe haven't looked at in a long time. And the one we have today is just one such example. The company is Universal Display Corp. And here's a couple of things I want you to note as I look at FastGraphs, a lot of historical information about a company. I see here that the company lost money the first 5 or 6 years of its existence as a publicly traded stock. And you can see the stock price really did nothing until the company started actually making some money. Now, I also see that the company started paying a dividend in 2017. Okay, that's the yellow line on the graph here. They did pay a dividend one time in 2013. I can see that by just looking at the graph. But here's what's interesting. This company has a 12% growth rate starting from when they actually had a positive number. All right. Now, if I bought the stock when it was close to fair value here, it's a PE of 18, a little high, but it had roughly a 12% growth rate over this time frame. And I ended up getting about almost a 16% rate of return because the stock is partially overvalued. But I also want you to notice something else. The market valued this stock at 55 to 60 PEs a lot of the time here. Okay, so if I go from, let's say, November of 2017 to current, you would have made a negative rate of return holding this stock for over all these years. And my point is the bizarre valuations that the company had. So in this example, we had a company that actually did pretty well, meaning earnings growth was almost 20% during this time frame. But the market was valuing it at these outlandish valuations, and so we end up losing money. Just the time frame I picked here was we lost almost 5% a year holding the stock. And again, it wasn't because the company did badly. And also look at their dividend. They doubled their dividend in 2018. Then they raised it again very high, strongly, from 24 cents to 40 cents, then to 60 cents, then to 80 cents, and so on and so forth. So their dividend has really grown nicely. They currently offer a 1.5% yield because the stock is still trading at a 24 multiple, but that's a lot less. But also notice the dynamic nature of FastGraphs. As I shorten the time frames, I get different growth rates and I get different valuation metrics. So valuation matters, and it matters a lot. And the one thing that I think Universal Display really shows is how you could have a company that does well and have this market just pricing it at outlandish valuations and have long-term investors not make any money because the stock is too crazy overvalued. It looks like it's an overvalued stock still. It does have a lot of growth potential. If I looked at it from the point of view of the market continuing to value it at these outlandish PE ratios, you might be able to make some money. But that's a big call. You have to really have a lot of confidence to believe that a company that's going to grow at 8 or 9% a year long term, maybe 18% a year, is worth 25 times earnings. But so far, the market said so. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. Hope you enjoyed this subscriber request video. I don't know a whole lot about this company, but I do find it interesting how high valuation really destroyed an investor's opportunity to make any money with it. If you like the video, ring the bell so you can get more videos like this. Subscribe to our channel, our YouTube channel if you haven't, and take a look at subscribing to FastGraphs. I couldn't even imagine investing without the perspective this tool offers. Thanks for watching.